I'm gonna go ahead and get started here, and then if anybody has any questions, I'll be glad to answer those as we go along. I do want to start off by saying that this is a class about investing, and or not class. This is a like mastermind. Our conversation is all about investing. You cannot be an investor and not have risk. The day, like everyone wants no risk, high reward, but that's not real. That's not reality. And so like you have to make sure that you as an investor and also that you as a realtor when you're working with investors are very upfront about risk. We can do things that minimize your risk, but if we minimize your risk, you also are going to minimize your return. You don't ever see, like there's this the reason that, high risk, high return, low risk, low return. Now we will do our best to try and minimize your risk in all ways, shapes, or forms, but can you lose money doing a real estate investment? 100%. Now, our goal is to help you understand how to minimize that risk, and that's what we're going to be doing today. Now, I know everybody here is great at math, right? I'm going to say yes, because if you're going to be working with investors and if you're going to be working with, being an investor yourself, then you have to be good at math. You have to understand how math works, the basics of it. We're going to be going through a lot of financial stuff today. And if that blows your mind, we'll put it back online, that kind of stuff. But nothing is like we're talking about addition, subtraction, a little bit of multiplication. It's really about it, right? We're not talking like hardcore. We're not splitting atoms here. So just embrace the math because it really isn't that difficult, but you do have to be able to that you have to embrace the numbers. Because for your investors, it's not about, oh, look how pretty it is. It's can I make money on this? Is this going to be a good return for me? Being able to instruct that and teach that and be able to show that is a very, very valuable asset that you can have. So let's kind of jump in a little bit here, and I want to talk a little bit about our investors right now. The president just came out the other day and said that he's trying to ban institutional investors. And while I don't necessarily think that that's a good, bad, or indifferent, the bottom line is institutional, the big time investors own 2% of real estate. So when it comes to all the investment properties, the big time investors, those guys, they represent 2% of the market. And not that 2% of the US market is small, but realistically it's not, like especially when you're talking about investors. When you're talking about investors, it really is about the small local regional investors. And those folks are not going to be impacted by anything that the president or anything that kind of stuff is doing. So, and honestly, that's a pretty good thing for us, right? Because um, for our for our investors, anybody know what the number one or the most frustrating part of acquiring investment property is? Anybody? Finding the deals. Finding the deals is number one, the hardest thing to do. And so if we can show them the deals and be able to break them down, we just met the largest need that our investors have. Now, unfortunately, for a lot of investors, the number one place where investors look for investment properties is they look online. They look for off-market deals. They wait for people to send them stuff. Like as far as like where, if you look at what percentage of investors seek out a real estate professional from the very beginning, it's like 15%. Really, really low. Most of the investors are having to do it on their own. Now, the reason that that's low is there's a lot of real estate folks that have no idea what they're talking about when it comes to analyzing an investment. They don't understand the language, they don't understand the process, they don't understand how the investment works. And that's one of the things that we're looking to kind of tackle today. One other thing that I want to kind of share with you about this, and this is one of the big benefits of when you start working with investors. First of all, you like I find that my buy and hold investors are way more loyal than my flippers. And we're not even going to go into flipping today. We're only going to be talking about buy and hold. Right now, roughly 70% of people that own an investment property want to buy another one. Okay. It's like 67%, something like that. But basically, two-thirds of all your investors want to buy another investment property. Roughly 20% of your investors want to sell an investment property right now. So, is this a good place for us to be engaged? 100%. This is a really, really good place for us to be looking to kind of operate in, and be ready to kind of work with folks here, because that's a like this is exactly what we want to do, who we want to do it with, that kind of stuff. So, but the trick is that we have to be able to find and analyze investment properties. So I'm going to kind of walk you through what that process looks like, how to do it. We're going to crunch the numbers ourselves as we go through. So please, if you would, like grab a piece of scratch paper, have some stuff out that you're going to be going over with on this. Be ready to kind of go through and kind of challenge yourself. Now, we will record this. This will go on Real Estate Backstory. If you would like to be able to refer back to it, you'll be able to do that. So give us a couple of days and then we'll get it put in on Real Estate Backstory where you can get it. But we're going to go ahead and kind of jump into it. So I'm going to start off. I'm going to give you a little bit of a gimme here. So, sorry. I found an investment property, or a property that I would be okay buying, if that makes any sense. Um, so, like, I'm always looking for deals. Right now, I think I have three flips running. I'm in the process of acquiring another property, and then we have investment properties. We have rentals. So so I'm speaking to you from somebody in the game, kind of understanding. You're like for me, it's a good way for me to be in real estate, but not necessarily compete with anybody. Right. So I just kind of work on the investment side. I've been working on the investment side for a long time. So like one property and you're welcome to pull it up while we go along. I may pull it up, share it with you, that kind of stuff here as well. But the property's address is 1410 Willow Drive. 1410 Willow Drive is going to be the address of the property that we are going to be looking at today. So it is a 3-bedroom, 2-bathroom, 1,365, 4-side brick, 1-car garage, fully renovated, ready to go property. It's currently listed for $160,000. So it's a good price. It is 1410 Willow Drive in Riverdale. If anybody wants to pull it up, let's talk about why I think this would be a good rental. First of all, I like 4-side brick. I do. They last better. My tenants have a harder time to destroy those, hopefully. Um, Roof looks good. It's already been fully rehabbed. I'm not going to have to do additional work on here. It looks to be move-in ready. The other thing that I pulled up is what can I rent it for? And so, as just a basic rule, I look at the 1% rule. And all the 1% rule really is if I buy it for $160,000, can I rent it for 1%? Can I rent it for $1,600 a month? And so I went into Zillow. There's a lot of different places you can go, but most of the time I go to Zillow and I see what will the rental rates run. And so if you look at this one, it says it's going to rent for $1,650 a month. So if I could buy it for $160 and rent it for $1,650, that's a pretty good one to look at. Now for you as a real estate professional, the reason these properties are preferred to flips and things like that, this is a rehabbed property. This is easy to sell. There's no additional work. You don't have to go get contractors set up and you don't have to go get all these other kind of things done. The other thing is once this investor gets it, fills it with a tenant, as soon as they get another 30 grand, they're ready to go buy another property. And that is something that you do want, like for us, we like to utilize DSCR loans, debt service coverage ratios. With those, I need 20% down. So on a $160,000 property, I need $32,000. That's 20% of $160,000. So for 100, so if I get 32 grand, I can go buy an investment property. Now, there's a lot of folks that like to go and pay their investment properties off with cash, and you can do that. And so you could go buy one property for $160,000, or I could take that same $160,000 and I can go buy five investment properties, and now my investment properties are paying off that mortgage, and hopefully I'm cash flowing. So the whole benefit here is that there's multiple ways to make money with rentals. But this is, for us, a lot of times everyone calls us, we get all these phone calls about, I'm looking for off-market properties. I'm looking for deals. I'm looking for off-market properties. And what I'm telling you is that like if you can analyze an investment and show it how it makes sense and how it makes financial sense, and you don't have to go through the whole searching off market, doing that kind of stuff. I pulled this property out of the MLS. So there's nothing magical about it, that kind of stuff. I mean, if you want, I will. Let me grab my screen here, and I'll even share it with you real fast, just so you know what I'm looking at. So I will share screen too. So here is our little investment property right here. Whoops, let me move that screen out of the way. So it is like I said, just a little 3-2 ranch. And this is a real property that we are now looking at. By the way, if you go in, you can even pull up. There's where I got my rental estimate on. You can also go in and pull up and see exactly what you can do the same when it comes to pulling rental comps. It's the same as pulling regular comps. You just go in and look at a bunch of other rentals to see what the rentals in the area are running. I mean, it's not rocket science, right? So we have our property. Let's start talking about the whole investment process here and how this works. It's all, and in addition, like when you start talking to your investors, and if you're considering this as a real estate professional, and honestly, I believe every one of you should own rental properties. Everybody should own investment properties. You're in the business. Now, I have some stocks, I have bonds, we have some other different investments out there. But you know what? You know what I know about stocks? I know squat about stocks. But you know what I do know about? Real estate. And I can find really good deals in real estate, and understanding how that process works. That's a really powerful thing. So I think there's something beneficial to that. Now, one thing that you have to understand when you're talking overall investments is how much work do you want your money to do for you? If you had $100,000 to invest this year, what kind of return would you expect on that? Like if you said, well, if I had $100,000, I would expect $10,000 a year. Well, then you expect a 10% return. If you say I have $100,000, I would expect $20,000, then you expect a 20% return. Now, understanding what different returns run can be very beneficial for you. For a lot of people, a 5 to 7% return, very modest return, those are pretty low risk returns. Stocks average 7 to 11% depending on the year. Bonds typically run in the 4 to 6% range. Now, bonds have been a little bit higher lately, but generally speaking, 4 to 6% on bonds. Gold runs gold's been running higher, but gold is pretty volatile, that kind of stuff. Real estate does appreciate at 4.5% a year, but there's more than just one. I mean, there's four ways to make money on a rental property. We see that a lot of investors are looking for a 10%, 12% return, that kind of stuff. And the reason that you want to have this conversation, you need to have this conversation with your investors beforehand. And the whole idea here is that, like, if I don't know what your investment goals are, then I can't find the right product for you to invest in. So if you say, look, I want to make a 20% return, okay, here's products that you can do that. If you say, I want to make this return, that's okay. Let's see what we're being realistic. Now, somebody's like, well, I want to make 50%. Well, I want unicorns to, fart cotton candy. That ain't going to happen either, right? So you got to understand that there is still a certain reality about what has to happen and what's coming along. But without a target return on investment, and the reason you have to have this, especially with new investors, New investors are like, I want to do good. I want to make money. They don't have anything identified. Well, if you don't have a target return, then you can't analyze any investment. If you can't say this is where I want to go, well, here's a tool to get me there, then they never make decisions. They can't make a decision because they can't get their head around, is this a good deal or not? So you have to talk to your investors right up front and say, what kind of return are you looking for? Now, with that return, there is also the risk versus reward kind of thing. Risk carries itself through investing the entire time. And it's important that we kind of acknowledge how that works. Because like a lot of times hear investors like, I want the best return. Well, your best returns are going to be on C properties. They're going to have the highest return. They're going to be the highest risk. I've had C properties and I had to replace windows because they got shot out with gunshots and like the tenants, you change tenants like people change diapers and they tend to be the least prepared. Like I will sell a C class property because it's too much for me to maintain. For me, I like B class properties, that kind of stuff. But when you look at the classifications of investment properties, A, B, C, A properties are the best properties in the best area. They are low risk, so they are low return. B properties, a little bit higher risk, a little bit higher return. C properties, high risk, high returns. So it depends on how much headache you like. For me, I've got enough headache in my life. I don't need more headache. So I stick with the B properties, that kind of stuff. But it depends on what, everyone wants the returns that you get on a C class property, but they'd like the risk of other properties. It just doesn't work that way. I'd like that it worked that way, but that's not realistic on there. So you have to start off with your target returns. Like I said, for a lot of people, it's 10 to 12%. Some folks are a little bit more modest, that kind of stuff. It just kind of depends on what you're doing. Some folks want a higher return, and that's okay. Now let's talk about how are we going to break down our investment. So I got to give you some facts and figures that you need to kind of understand and get your head around how these things work and where they work in the investment scenario. So one I've already given to you, and that's the 1% rule. You definitely want to have be able to see what that 1% rule is. Now, the challenge with the 1% rule is the higher the price, that stops working. So like I can definitely buy a $160,000 house and rent it out for $1,600 a month. I'm gonna have a real hard time buying a $500,000 house and renting it out for $5,000 a month. So we see that that doesn't work once you get past about 300,000. It doesn't really work on there. But we find that most of the time investors are dealing in the entry level price points. We don't have nearly as many investors in the high end because you end up with much lower cash flow. You still get decent returns, but they don't cash flow as much. If you have an investor that wants cash flow, the 1% rule is going to be essential for you to be able to make that happen. And I'll explain that more as we get into the actual numbers here. Now one thing that you do need to understand is like cap rate and cash flow on cash. But if you are going to calculate cap rate, then you have to calculate this thing called NOI, net operating income. A lot of investors will talk about cap rate, they'll talk about all these other numbers, but they won't talk about net operating income. Net operating income is, in my opinion, one of the most important numbers that you need to know. And it's also not difficult to calculate. That's the great part, right? We can calculate net operating income on just about any property out there before we even buy it. And so we can come really close with what that's going to run. Now, let's talk about what encompasses net operating income. So, net operating income starts off with what your gross rents are, how much you're renting for, less your operating expenses. Now, when it comes to operating expenses, we are not, well, first of all, we're not talking about mortgage payments. Okay. That comes in later. We're not talking about any kind of capital expenditures or depreciation or income taxes. That's not included in your normal expenses. Now, what I'm talking about is your gross rents, and then taking off that, what does it cost you for your property taxes? What does it cost you for your insurance? What does it cost you for maintenance, repairs, property management fees, janitorial fees if you're in an apartment or something like that, landscaping fees, and then vacancies? Now, all those numbers we can easily calculate, right? And by the way, we're going to do that here in just a minute. We're going to do that on that investment property. So, let me kind of wrap up. We're going to take our gross rent, whatever that rent amount is, and then from it, we're going to take away our taxes, our insurance, our repairs, property management, vacancies from that. And then that's going to give us a total amount. Now, if you want to know what your cash flow is, all you take is your net operating income less your mortgage. That's what your cash flow is. That's not a very difficult one to calculate at that point. But if you don't have net operating income, you can't calculate cash flow. You also can't calculate what your cap rates are. Now, there's a lot of investors that talk about cap rate, but they don't understand what cap rate really works. Cap rate only counts for where that property is at this current point in time. It doesn't account for any future earnings or anything like that. So I'm not saying it doesn't have any reference, but understanding where it works in the scheme of things. A lot of people talk about cap rate, but don't understand how cap rate works. I'm telling you that the most important number, in my opinion, that you need to be able to calculate is net operating income. And you can do that. You can go see how much a property rents for. You can pull up what the property taxes were. You can estimate insurance. And by the way, when it comes to insurance for investors, like I have insurance on the building itself only, not on contents. So if I had to rebuild the building, that's what my insurance is. So you'll see that investors' property insurance is a little bit less because I'm not insuring the contents. I tell my tenants, you need to insure the contents of the building. So if the building goes up in flames, oh, that's you, right? I'm gonna, like my insurance needs to pay if I had to rebuild the building, that kind of stuff. Now, I also don't insure the land because unless you nuke it, it's just going to still be there, right? So, like, all I'm doing is insuring the building only, and that keeps it, my insurance tends to run 100 to 120 bucks a month is about what it kind of works for most of our investment properties. Some a little bit more, but generally speaking, 100 to 120, some are 140 bucks a month, that kind of stuff. But generally speaking, that's our rough price point on that. You can estimate any kind of maintenance or repairs, just being realistic about it. I normally throw 50 bucks a month into repairs. I always include property management in all of mine because I need a property manager. Property management is one of those things that is like I found out what a bad property manager I am just because I went to pick up rent once and then I ended up buying groceries and diapers and all that kind of stuff for my tenant just because I'm not the great like I can't go be a pit boss, that kind of stuff. So I need a property manager to handle that, plus understanding all the legalities and that kind of stuff. Having a property manager is very, very important to me. Plus, I don't like driving around with a plunger in my trunk, having to fix that, getting called in the middle of the night. I'll use a property manager all day. Property management runs you 8 to 10%. 9% is kind of a pretty universal number on here. So we're going to go through and we'll calculate what our net operating income here is in just a minute. So we've got the 1% rule, and we know how to calculate our net operating income. Now, if you want to calculate what your cap rate is, and again, cap rate is nothing. Here's your cap rate calculation. Annual net operating income, annual NOI divided by the purchase price. That's your cap rate. So if I have $10,000 a year in net operating income and I buy a property for $100,000, it's a 10%, 10 cap. If I get $5,000 on that same $100,000 property, it's a 5% return. So cap rate is just like the challenge with cap rate is it only accounts for where that property is when I buy it. It doesn't account for anything in the future, none of my future earnings, nothing else going on, just where it sits right this minute. And that's also based on my estimate of what my NOI is actually going to be. So it's not a bad number, but a lot of people put so much weight on cap rate and don't actually dig into it. You, as the advisor for your investor, being able to understand net operating income is way more important, and being able to calculate it out is also very, very important. Now, one other number that you definitely want to know is your cash on return investment, and all that really says is this is how much I put in the investment. This is how much the investment makes on an annualized basis. So we already said that, like on this property that we're going to be analyzing, I'm going to have to put $32,000 into it because that's going to be 20%. I need 20% down. So to buy this $160,000 house, I want to buy it for $32,000. Any kind of return that I get, so let's say I made $10,000 a year. $10,000 divided by 32,000, that's my annualized return, for example. So, um, and those are really the four like the most important numbers that you're going to need. Now, an investor is never going to use just one number to make a decision about a property. But you do need to make sure that you understand these investment strategies. If I understand the 1% rule, how to calculate my net operating income, now we can get into the four ways that a rental property makes money. Because there's four ways that a rental property makes money. Now, most of your investors think that a rental property makes money one way, cash flow. And I get it. Cash is king. Everybody wants cash flow. I'm all about cash flow. I like cash flow. Cash flow is good, but it's only a quarter of the story. For a lot of your properties that are higher end, more expensive properties, you'll see that they don't cash flow that much. As a percentage, it's going to cash flow even less, and they might not cash flow nearly as much. So I'm not saying that you shouldn't worry about it. What I'm saying is that you got to understand that we have to take the entire investment picture and be able to show that to an investor. Now, to calculate cash flow, we've already talked about it before. But if I'm going to calculate cash flow, I'm going to take my annual net operating income less my mortgage. Or so like let's say so if I get net operating income of $1,000 or $1,200 a month, and my mortgage is $1,000 a month, that means my cash flow is $200 a month. Times 12, that means my annual cash flow is $2,400. For a lot of investors, they'd be like, yeah, $2,400. Is that enough for me to really throw out there? Like, is $2,400 enough for me to to put my money into this investment? See, they're missing out on the fact that there's three other ways that we're gonna build wealth or produce wealth with this investment property. So in this scenario, we got $2,400 in cash flow a year. Now, for you as a real estate person, are you going to invest in a property that makes $2,400 a year? Some of you will, some of you won't. But if you don't understand the whole picture, a lot of people would be like, it seems like a lot of work for $200 a month. So let's look at the other ways that a property produces wealth. The other way is through just good old-fashioned appreciation, right? Property value appreciation. Now, for me, I find that most of my investments run about 4 to 5% a year. If you look at property value appreciation over the last 50 years, it's appreciated at 4.4% a year. Now, I don't normally calculate 4.4% a year. I calculate 2.2%. I calculate half. So if you let's just say you did buy a $300,000 house at 4%, that's a $12,000 value appreciation every single year. Even if you predicted half of it, that would be $6,000 a year, right? Let's say I'm going to make $2,400 a year on cash flow. I could also make $6,000 or $5,000 a year in property value appreciation. And is that real? Yes, it's absolutely real. Like when you look at the reason why so many folks Like where does wealth in the United States come from? It comes from owning real estate. And that's because every year when you continue to pay off your mortgage and do all those kind of things, that property is continuing to build wealth. Now we had double digit property value appreciation, like after COVID, that kind of stuff. Matter of fact, here in Georgia, it was over 50% over the last 5 years. We've had property value appreciation. It is much more modest. We're in the 2 to 3% range right now overall. But like what we see is because so many of our investors are buying entry level, your entry level properties tend to appreciate a little bit better. So all in all, I tend to calculate out 2.2% on my appreciation. Now that's so we have cash flow, we have appreciation. Our next way is amortization. Amortization is, and it's a big word, and most real estate folks have not looked at an amortization schedule since they went to real estate school. And all amortization is how much of that loan have you paid off, right? So like all you're doing is comparing your year one normally on what your amortization is. Now, the longer that you own a property, the more that amortization goes up. Because like in the very beginning of a loan, it's mainly interest, right? You're not paying down a lot of principal. By the time you get to the end, farther in the loan, you'll see that your amortization really starts to improve. And so the longer you hold that investment property, the better that's going to look. And all you do is like look from year one to from year one to year two, what did your loan move from? And so like um, on a $300,000 property, on year one, you owe $300,000. At the end of year one, like you may make $2,500 in amortization, meaning that you paid off that loan. The loan is now not 300,000. Now the loan is 297 and change, right? So being able to calculate that, you're building that wealth because now you owe less on that property. And so that is real seen savings. So we have cash flow, we have um, amortization, we have appreciation. The last way that we have the real estate, that a rental property produces wealth is depreciation, right? And I know a lot of people don't take depreciation on their rental properties, but they should, because when you sell it, you're still taxed the same way as if you did take depreciation. So you should be taking depreciation. Now, depreciation causes a lot of people some angst and it makes people's brain hurt. And I'm not trying to make your brain hurt, but I do want to explain how depreciation works. So you cannot depreciate land. That's the easiest thing to understand right off the very beginning. Because like what you have to do is take your purchase price less the land value, and that comes off with what's called your cost basis. All the cost basis is the purchase price less the land. Now, where do you see how much the land is worth? You can check your county tax records, or if you have a recent appraisal, it will show you what the land value is. So most of the time, I'll take the county record. I'll just pull it up in tax records and see how much they're putting towards land value. So in this example, if I have a $300,000 house and it's got $50,000 worth of land, well, then that means that my total cost basis is $250,000. Now, how much can you depreciate by year? Well, you can depreciate by 27 and a half years. So I'll take that $250,000, divide it by 27 and a half. And that gives me, like in that scenario, it's about $9,000 a year, 90. But that's not true savings, right? That's how much you can write off of your taxes. So if you're on a 33% tax rate, if you take 33% of your $9,000 means that you might get three grand or $2,700 in depreciation. Because see, what you want to understand is that you want to add all these things up because these are all true wealth building mechanisms that's built into this. Because see, it's one thing when you say I have a property and it produces $2,400 a year in cash flow. Maybe not. But if it produces $2,400 in cash flow, $6,000 in appreciation, $2,700 in depreciation, and $2,400 in amortization, Now that property is producing $13,000 a year in true value growth. If you put in, say, $60,000, well, 13,000 divided by 60,000, that's a 20% return. Like that's when the numbers start looking really, really interesting. Because as an investor, what was your goal? What was your original target return on investment? Right? You got to understand what that if you're at 10% and I just show you here's how you can take a property and make a 20% return, and your goal was 10, well, suddenly you think I hung the moon. You think I'm the smartest person in the room, right? So yeah, you might be able to get 10, 12% from stocks. You might be able to get 6, 7 from bonds, but I'm showing you an investment you can make 20% on. That's a pretty good deal, right? You follow me? So let's talk about actually going through the property. So we're going to go back to the property I showed you, right? So we're going to go back and we're going to look at what's the address of my little property? Let's see. 1410 Willow Drive in Riverdale. So let's break this investment down together here while we're at it. So I am a napkin or a scratch paper investor. So I take my paper and I draw a big X on the front page. I draw an X on the back too, by the way. So I just take a piece of paper, just draw a big X on it. In the top left-hand corner, right? Income. And then you want to go and look up and see how much that income is. And so you already know, we already pulled it up. I showed you earlier, our income on this property, 1650 a month. Okay, so write 1650. Now, underneath there, you want to write expenses. So top left, income, bottom left, expenses, taxes. Well, how do you find taxes? It's not that hard. So you can pull up the tax record, that kind of stuff. Um, so if you pull up the tax record, uh, and I'll go in. So the taxes on this property is $2,190. And by the way, you could see also if it was homestead and that kind of stuff, because if it is homestead, your taxes will go up on year two. You just got to understand that. But for starting off right now, this property wasn't homestead last year, just residential, that kind of stuff. So I had taxes of $2,190. So if I take 2,190 divided by 12, that means that my monthly taxes is 182.50. Not hard to calculate. All right. Next thing, insurance. I'm just on this little house, I'm going to say $100 a month. You can call an insurance agent, and those kind of things, but make sure that you are getting investors insurance. By the way, your investors insurance only counts if the property is occupied. You can't keep an investment property vacant for more than 2 months, or else your insurance doesn't count. Just wanted to throw that out there. When it comes to your other expenses here, right? What other expenses do we have? Well, I only add in like utilities, electric, water, garbage, that kind of stuff, if it's included. For none of my investment properties are included, but if it is included, then you have to account for that expense, but I'm not accounting for that expense. Vacancy. I always calculate in 5% for vacancy. The reason I do that is because at some point your property will get vacant if you don't put some vacancy. And so I'm going to change gears just for a quick second, explain something. On all my investment properties, I have a checking account and I have a savings account. And every month I take some money from that when my tenants pay me, I take that into my checking account and I put a certain amount over into my savings account. And like I put over the money for the taxes, for the insurance, for the mortgage, for the property management, all that kind of stuff. I move that over into that other account. I do start to build up a bit of a nest egg because I also put in there if there's any kind of repairs or any kind of capital expenditures that I'm putting in there. I put all that money into there so I can pay it out of there. The things I need to save on that side, The stuff I'll pay on a monthly basis, I'll leave in the checking account, but I'll move that money over into there. So we calculated that, we got 182 in taxes, $100 in insurance, vacancy at 5% on 1650, it's 8250 a month. So I'll put away 8250 on there. Repairs, I like to calculate in about $50 a month, just because at some point you're going to have to send a plumber, or you're going to have to do this, or you're going to have to make some kind of, or the HVAC is not going to work, or that kind of stuff. Every month, put a little bit of money aside into that savings account, because then when you have to send the plumber, it's not as painful. If you start taking everything out of that investment property as you go along every month, and then you have to make a repair, or you have to, or it sits vacant, it can be really, really expensive. For me, because I've got money set aside every month, I put some money aside for vacancy, I put some money aside for repairs. So if I have a month with no tenants, I'm pulling that money out to cover my expenses that month, because I paid that money ahead to build that up into my nest egg. Also, property management would be part.
Hi, good. How are you?
Hello?
Okay.
Okay, okay. Sorry, I muted somebody. Getting back to this. So I go through all my expenses. So taxes, insurance, vacancy, repairs, property management, all the way through. Then the other thing that I do is I go through and I calculate out what my mortgage is going to be. So you can go and pull it up in any mortgage calculator in the world. But when you do your mortgages, when you do the mortgage calculator, you're only doing principal and interest, because taxes and insurance, it's already done separately. So you don't have to do the whole pity thing. You can, but it's just easier as an investor while you're going through. All you're doing, and you do want to see what your mortgage is going to run. So so all I'm doing is tracking my NOI. So I list all my expenses out so I can calculate my net operating income. And then that's what I put my net operating income and my cash flow in the top right-hand corner. Top right-hand corner, all I'm going to do is so my net operating income is nothing but my 1650 less 182 for my taxes, $100 for my insurance, 8250 for my vacancy, $50 in repairs and capital expenditures, and 148.50 in property management. That means that I have, if I take that, and then that gives me my, so roughly I get to end up with like $1,000, because if I start off at 1650, take all those away, I have a little over $1,000 right there. My mortgage is 80905. So I take away my mortgage, because in order to calculate cash flow is nothing other than net operating income less mortgage. So that's all I need to be able to calculate that. So my NOI is 1,086 a month. My mortgage is 809 a month. So what's that leave me cash flow? 277 and change, 277.45 a month, because and so now I've got all this listed on this page. Now, the bottom right hand corner, this is my, this is my other calculations. So I'll put in here, this is where I calculate out what my 1% rule is. So 1%, if I'm buying it for 160, I got 1650 a month in rent. That's greater than 1%. So they hit that one. I calculate my cap rate. All cap rate is my net operating income of 1,086 times 12. So $12,000 divided by 160, $160,000. That's how I'm going to calculate what my cap rate is. Now, at this point is when I flip my paper over, right? Because this is where your real income comes from. So on the other side, I already know what my cash flow is. Here's where I calculate. So in the top left-hand corner, I put appreciation, right? So if I take $160,000 times 2.2%, not hard to do. Let's pull it up right now. 160 times 2.2%. So that's 3520 a year in appreciation. So 3520, got it. Amortization, that same mortgage calculator that we looked at, right? All you do for your amortization is see how much it was, how much your amortization was on year one. My amortization on year one is $1,430. Okay, that's the bottom left-hand corner. Top right-hand corner, depreciation. So for my depreciation, I have a purchase price of $160,000. I take away my land value that I got from tax records, which was 17,160. So that gives me a cost basis of 142,000 and change. Divide that by 27 and a half, gives me a total of 5,194. I only take a third of that because my tax rate's about 30%, and that leaves me with a true cash value of $1,714. Now, the bottom right-hand corner, that's the one where the rubber meets the road, right? Because for me to calculate all this I just kind of list all my stuff out there. So cash flow, I get $3,329 a year in cash flow. I get 3,520 in appreciation. I get 1,430 in amortization. And I get 1,714 in depreciation. And that leaves me with a total value increase of $9,994, almost 10 grand a year. Now, do you remember what my initial investment was? It's $32,000. So I made a $32,000 investment that I'm making $10,000 a year on. That's a 31% return on investment. And I don't know where you're going to kind of touch an investment that makes more than the 30%. So like that's how I break down a property. Being able to take that to an investor makes you invaluable to them to be able to go and break these kind of numbers down. Also, being able to show your investor different options, right? What happens if, and like if you just look at that number, what happens if we appreciate more than 2.2% a year? Well, then my returns improve. The longer I pay off my mortgage, my returns improve. What happens if rents get raised? My returns improve. What happens if you manage the property yourself? Your returns are going to improve. I mean, like you have a lot of control to be able to look at what these numbers really do. Being able to take that and be able to like I would never take this property here. What is it, 1410? Yeah, 1410 Willow Drive. Please do not go send out 1410 Willow Drive to investors. What you do is you take a picture of this property and you say, here is a property. If you've got $32,000 as an investor and you want to get a 30% return, call me because I can get you in this property with a 30% annualized return every year. You can take and turn this into a newsletter. You can do this out on social media. But being able to turn this into investment or to be able to take an investment, break these numbers down, I know it may seem like I went really fast or it may have seemed kind of confusing, but where else are your investors going to be able to make a 30% return? I find that that's an incredible return, being able to get back almost a third of your money every year that you put into it, right? And now that investment is continuing to pay that, it's continuing to pay that mortgage off so that you own more and more of it as it continues to go on. And you just put $32,000 in is your big investment that you made in the thing. I can't express to you how beneficial and financially rewarding it is when you can break an investment down for investors like this. What I walked you through is how I look at an investment, how I decide should I buy this property. And if I was looking for an investment right now, I'd jump all over 1410 Willow because I think that's a great investment. It's a no-brainer. there should be investors lined up to buy this thing as far as I'm concerned because it matches with everything that I like. It's got a lot of very positive features. But what you find is that when you can partner with an investor that buys a property like the one at Willow, and you get them in and they buy one, they don't stop at one, right? They're like, wow, that's a great deal. Can you find me more? Because every time they get another 30, $40,000, what do they want to do? They want to buy another property kind of thing. And then when you are the go-to, when you are their guru, when you can explain what their return really is on these properties and what these numbers break down to, I'm telling you, you are invaluable to them. So being able to do this I mean, it's one thing to do it for yourself. I learned to do it for myself. What I'm telling you is that we took that same thing and started doing it for other investors and built and sold a lot of houses. Like my favorite part about selling about like working with investors is I don't have to go get repairs. I don't have to they're not looking for flips. They're not searching for off-market properties. I pulled this out of the MLS. So it's not like it was like, oh my gosh, how'd you find this? I found this property by going through the MLS and seeing what the rental rates are running, checking out the areas, knowing your markets, that kind of stuff. It is really that simple. So I ran a little bit long. I will open up for questions and talk to you guys about how to analyze an investment and that kind of stuff. If you have anything, this replay will be out next couple of days. We'll see how long Mackenzie will normally try and get this thing up onto Backstory if you want to go back through it. If anybody needs anything else, I'm just going to kind of hush and see what do y'all think? Questions, comments? I'm wide open.
Hey, Alan, question.
Yep.
Um, the classification ABC, like,
hmm
are you just looking like on neighborhood reports to classify it?
Um, it really comes down to just kind of like it's about risk. And you'll see that like A properties, those are the best properties in the best areas and they're newest, right? Most of your A properties are less than 10 years old, that kind of stuff. Um, B properties are going to be, somewhere between 5 and 10 years and a little bit older. They're not going to have any kind of deferred maintenance. They're not going to need any kind of repairs done. They're not that kind of stuff. Your C properties are always going to need some work done. They're going to have some deferred maintenance. They're going to be in the areas that maybe weren't the greatest areas anymore. Maybe it was a really good area, but it's kind of moved away from it, that kind of stuff. But it really what you're looking at is risk,
Okay.
right?
Okay, got it. Okay, thank you.
Sure. Nobody has any other questions?
Good morning, Alan.
Hey, Linda.
Hey, do you have like a spreadsheet where we could plug in those figures and automatically calculate or no? Like, and there was one time one investor told me, someone had told me sort of like a similar formula where they want a certain percentage return on that investment. And is that what you gave us today?
Yeah, that's what I gave you today.
Yeah.
Um, yeah, there are some spreadsheets that you can use. You can see, so you can find one inside art, like if you're a realtor, if you go into RPR, you can see one inside RPR. That it's called Valuate inside RPR, and so you can plug those in there. Now, all these spreadsheets, that kind of stuff. One thing you're going to find that's pretty consistent is you're going to have to calculate your NOI. And that's why I say it's so much more important to be able to understand how to calculate NOI. But you can once you calculate NOI, that solves so many of the problems for you. You're still going to have to do all the work. And so as long as you understand where the numbers come from and what they mean, whether you plug it into an Excel spreadsheet, Valuate, whatever, that kind of stuff, those things help it look pretty and to help you kind of seal the deal, as it were. But it's important that you understand that there's four ways that a rental property makes money and how you can calculate each of the four. And of those, like I said, understanding depreciation, once you get that under your head, figured out, then depreciation's easy to figure out. NOI is the other one that tends to throw agents off a little bit. Because once you understand NOI, then you have cash flow, then you have cap rate. You can calculate both of those because both those numbers work off net operating income. I don't know if that made sense. I hope it did.
Yes, thank you. Now,
Absolutely.
you used to have investment classes to teach people a little bit more. Do you still have those
I
classes?
do. I do. I teach an investing class on both on this as well as on flipping. I wanted to take and do this one a little bit more slowly. That class tends to be like drinking out of a fire hose because we go out of this one and then we start talking about doing flips, and everyone's very, very interested in doing flips. But I can tell you, it's kind of like it's like the difference between like Warren Buffett investing and investing in like snazzy new businesses. Warren Buffett made a lot of money very slowly. That's the whole idea, right? And so like with investing, it's not nearly as sexy and flashy as a lot of your other investment strategies, but it makes a lot of folks a lot of money. And so I wanted to take some time to explain that, but yeah, I do teach that. If you'll check out mx1training.com, I had some coming up. I've got surgery coming up, so some of my I'm not doing quite as much over the next couple of months because I'm having my hip replaced because I'm that old, right? All the gray is coming through here. So,
Okay.
I have hip surgery coming up, so I'm a little bit tight on
Okay.
classes. I can check. I think I saw Adrian was on here earlier, but she normally handles the schedule, and we can try and get one on there because I do the same class in person, but I don't spend nearly as much time explaining and breaking it down as I have with you guys today.
Okay, sorry to hear that, but thank you.
Oh, that's all right. I'm aging like milk. So, all right. Anybody have any other questions, thoughts? Anybody gonna take this and go start showing I hope some of you steal 1410 Willow and like don't send the address. Just say, "Hey, I've got a great investment for you at a 30% return. Call me." Like please, I hope one of you takes this property and sells the daylights out of it. You should be posting this on social media. You should be getting it out there. Like steal from me, and then go find more just like this. Like the process of it, like if all you did was go and take one of these investment properties a day, find one, and then post it and share it. But don't share the address. Just share the details. Like this property has a 30% return. This one has a 15% return. Da 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 da. That kind of stuff. When you can share these kind of things, investors will find you. Other questions? I see some folks turn their mics
No,
off.
but I'd be interested to know who is going to actually share it. If you raise your hand, that'd be awesome. And
Oh,
if
you
you're
want it?
going to work with investor, please make sure that you have a script or at least start doing something with ChatGPT to where you can some rebuttals and what have you. Most of the time, investor wants to know that you know what you're talking about. And that's what's going to create the loyalty. Don't be one of those folks that create a fake, what I call spreadsheet, because investors going to find that out and they'll never use you again.
Yep. All right, Shoney's going to share it. Good job, Shoney. I seriously, if you're interested in working with investors, steal the crap out of this. Right? Like share it, find other properties like it, that kind of thing. The whole idea about sharing this is not so much that they buy this property. It's that you show that you know how to speak the language of investing. And even if they don't, like by the time that you actually get around to actually showing this property to somebody, it may be gone. But if you can show this process and then you can start finding others, that's the gem. There you go, Gina. Good. All right. Does anybody have any other questions, thoughts, concerns? I hope I wasn't too confusing. I know it's kind of a lot of math.
No, it's not hard and it's great information. Thank you, Alan.
Awesome. All right. Anybody have anything else? Anybody be of any
Yeah, I'll
service?
go rocket in 2026.
Yeah.
I want to know the criterias when searching for them in FMLS.
The easiest thing For me, I like having multiple screens open. And
Oh.
so when I'm looking at investment properties, I'm looking at rental rates on one screen and I'm looking at the properties on the other. Because if I can't rent it, if I'm looking for buy and holds, then I look at both rental rates and I look at purchase price at the same time. Because if I can't rent it for enough, then there's no point in me going forward. So really, that's all I'm looking at. That's why I like to have two screens. One has rental rates. The other one has the properties. I'll find a property that looks interesting. I'll pull up the rental rate. Okay, it works. It doesn't. That kind of stuff. I start with that one, and then I can go deeper into the numbers. Now, one thing you do want to watch out for, like on condos, townhomes, those kind of things, you got to make sure you build in HOA fees into those. Because when you first start looking at like condos and townhomes, you think this is great, but you got to build in that extra cost because that's something else that would fall in under HOA that would be part of your net operating income.
And I will
That makes
tell you,
sense?
be cautious in downtown Atlanta because they're running about, so far, the minimum I see for those condos and high rises, they're about minimum $550 a month. And
Some
they're
are
up to about
$1,000 a month in HOA fees.
1,500 to
Yeah.
$1,500 to $2,000 per month. This is not per year, per month.
Yeah.
So, but they have all the concierge services there too.
Well, and sometimes it takes care of sometimes it takes care of like your HOA, I mean your homeowner's insurance and that kind of stuff. So look at all those things. So any other questions? I wish you nothing but success. If I can be of any service, please call, text, smoke signals. We
Yeah,
love
once
y'all.
again, go rock it in 2026.
That's it.
Have
Bye, guys.
fun.